Yeah, there's no doubt about it. Spring is in full force here in the Boise area. We got a ton of rain over the past 5 days. And it kind of reminds me of growing up in rural Minnesota, where spring was just really muddy. Now, here, of course, in the city, not much mud, lots of pavement. However, you get anywhere out into the desert or into the country, and you're spinning your wheels. There's a lot of mud. So, what does that have to do with what I'm about to talk about, which is the unemployment report? Well, a lot. The unemployment report is really what the Fed has been hanging their hat on, that and inflation. They've been frustrated, as has the whole country, right, with the inflation coming down so slowly, just barely ticking down every month, like 0.1% or nothing, depending on the month and depending on the report. So it's been a very slow decrease, like I talked about last week with the PCE report coming down just 0.1%. So the Fed has been, instead of focusing only on inflation, they're also focusing on the employment and unemployment rate. So last Friday, the BLS came out with the official unemployment rate, which came, fortunately, I guess, from one side of the aisle, if you look at it this way, it came down actually from 3.9% down to 3.8%. There were expectations that it would remain the same or be a little bit higher at 4%. And that's because there's been a lot of underlying weakness in the report itself over the past few months. That weakness remains. The household survey showed that full-time jobs, there were no full-time jobs gained, only part-time jobs. But the headline number of the business survey said 303,000 new jobs were gained, as opposed to the 200,000 that was estimated. So it kind of blew the estimates out of the water. The headline looked great for all the news outlets and for politics, et cetera. So it looked strong, but you go under the surface and it looks like they were all, or most of them, part-time jobs instead of full-time jobs. So that's been happening over the last number of months. So what does that mean? At some point, is the economy kind of going to crack and we're not going to be able to continue these reports with these large numbers? I think so. It's just a matter of when. We thought it would happen by now, but it hasn't yet. And we still keep getting these huge headline numbers, even though the underlying jobs are weak. They're part-time. So people are doing multiple jobs to make ends meet and move things forward. But the markets react to the headline. And so what ended up happening because of that? Well, the Federal Reserve, of course, this is, as you look at Federal Reserve market odds on when they're going to start dropping the federal funds rate, a few months ago, it was like 70-80% likelihood that they drop rates, even 100% in some polls, that the Fed would start dropping rates by May or even June. June at the latest was like 100% certainty. Now it's down to like 48% certainty that the Fed's going to actually do their first rate reduction in June. So could it happen? Maybe. Is it likely to not happen? Yeah, probably, unfortunately. They're waiting for the economy to weaken, for unemployment to rise, not go down. So they expected the unemployment rate to go from 3.9 to say 4% or 4.1. Instead, it went from 3.9 to 3.8%. So unemployment actually dropped in response to this unemployment and this employment report that came out on Friday. So things go in kind of the wrong direction for us to find any meaningful reasons for the Federal Reserve to hang their hat on to drop interest rates anytime soon. That's the bottom line with what we've seen as of last Friday and then the week before PCE. This week, we're going to get the CPI, the Consumer Price Index, another inflation report. We'll see, will it show weakness? Will it show inflation coming down? I don't know. We're going to find out. It'll be interesting. So let's take a look at the charts here so you can see how the markets have reacted to this stronger than expected unemployment report, or employment report in this case, because we had more employment than expected. So here's where we're at. As of last Friday, we had a drop in the price and another drop today. So it kind of looks like we're stair-stepping our way down towards this 200-day moving average. That's not good. Again, stair-stepping down means the price is dropping. When the price drops, that means the yield and the rate are rising. So we're going the wrong direction. We're kind of heading back towards that level we were at with interest rates down towards the end of February. I want to show you something interesting, though, just to give you a little bit of, hopefully, of positivity here, so you can see that things aren't all that bad compared to what we had been at. So if you look back to last October, this is where those mortgage bond rates were at. This is your 30-year mortgage bond, quite a bit lower the prices and the pricing back in October. We're not anywhere near that yet, right? So hopefully it doesn't happen. Hopefully we don't get to the point where we have mortgage bond pricing dropping off a cliff like we had last fall with those very high interest rates pushing 8% on 30-year loans. We're not there, right? Rates are still in that high 6, low 7s range, depending on your qualifications, depending on the loan program, down payment, credit scores, etc. So we're still in decent territory, although they are a bit higher than they were a few weeks ago. and kind of heading towards where we were towards the end of February, which was the highest point of the year. So just wanted to give you that update so you could get an idea of where things sit. And if you have questions, of course, about any of this, about unemployment, employment rates, interest rates in general, etc., please let me know. Continue to follow me on Instagram at @TheBillZimmerman for more updates as we go. And I hope you have a wonderful week.